The last week in the stock market has been insane. The S&P 500 fell by more than 5% at the beginning of the week, extending what has been the worst year-to-date market performance since war times. But it then later recovered by more than 4%. Now, if you're like me, you're probably asking yourself, how am I meant to know what to do with my investments when the market keeps flip-flopping between dips and recoveries? And you want an answer to that question before things get any worse, because the last thing you want is your portfolio looking like this. Some analysts are saying that this recovery is a bear market rally with more losses to come. That would mean that stocks are simply taking a temporary hiatus from plunging into the abyss, while other analysts are saying that the bull market still has many years left to run. Clearly, not everyone agrees on what direction the stock market is heading in the years to come, which for you is unhelpful to say the least. So we're going to try and decide whether or not the stock market has bottomed out, and we'll do so in consideration of all the facts and circumstances which may or may not prevent a recovery from happening. We first need to understand how the market is currently feeling about stocks, and to do so, we can use the CBOE Volatility Index, better known as the VIX. The VIX is used to measure how much fear is in the stock market. When the VIX goes up, that means investors are expecting future stock prices to be quite volatile, specifically stock prices for the next 30 days. Since the beginning of 2022, the VIX has gone up by nearly 75%. There's many reasons why this has happened. Since the beginning of the year, Russia invaded Ukraine, inflation hit 40-year highs, the Fed has increased interest rates, and the global supply chain system has continued to suffer. None of these events are positive for stock prices, hence why negative sentiment and fearfulness have returned to the VIX. What's interesting is that since 1990, the VIX has had an average level of 37 when markets have bottomed out. Yet, even after the S&P 500 has declined by 16% in 2022, putting it near bear market territory, the VIX stands at around 29. Now, what this tells us is that investors are likely expecting the market to continue dropping over the coming months, meaning we would not yet be at a market bottom. When the pandemic broke out in March 2020, the VIX hit an all-time high of 82.69 before central banks stepped in with monetary policy to keep the economy churning. So clearly, investors today are nowhere near as fearful as they were when the market was crashing in 2020. But still, we would expect the VIX to be higher if this truly was a market bottom. That begs the question, why are investors expecting further future drops in stock prices? One reason is the ongoing tug of war between interest rates and inflation. Inflation has been a persistent problem for a while now, and the April data from the US suggests that while inflation growth is slowing, it's not slowing as fast as economists predicted. One report suggests that 2/3 of Americans are living paycheck to paycheck amidst inflation being at its highest level in 4 decades. Getting inflation and the cost of living under control is a top priority for global central banks, who are responsible for maintaining price stability in the economy. In order for them to do that, they need to increase interest rates. The Federal Reserve has already increased interest rates twice this year, a 0.25% increase in March and a 0.5% increase in May. You see, inflation is the byproduct of demand outstripping supply, and in October 2021, the demand for durable goods was 40% higher than it was just 3 years prior. That was largely the Fed's own doing, having kept interest rates at near zero post-pandemic and by effectively printing trillions of dollars via quantitative easing. So, to reduce demand, the Fed is now increasing interest rates in order to make it more expensive to borrow money. Here's the issue. The Fed wants to increase interest rates in order to obtain the neutral rate of interest, which is the interest rate at which the economy is neither being stimulated nor restricted. Some commentators have said that the neutral rate is between 2 and 2.5%, but with inflation being as high as it is, others have said that a neutral rate of between 5 and 6% is more accurate. Plus, as we already outlined, the exact trajectory of inflation is unknown. Point being, there's uncertainty around how high interest rates will need to go in order to curb inflation. Interest rate uncertainty is bad news for investors because higher interest rates negatively impact company valuations. This is especially true for growth stocks, which is largely the reason why the Nasdaq is in a bear market. Even though Jerome Powell, the chairman of the Fed, said that larger interest rate increases like 0.75% are not actively being considered, that doesn't mean it won't happen. In fact, St. Louis Fed President James Bullard has said that such increases could be an option. This all boils down to one simple fact. The Fed has a reactive approach when it comes to increasing interest rates. We know that their guidance for June and July is consecutive rate increases of 0.5%. But if the inflation data is worse than expected, then the actual rate increases could be higher, which would send the stock market lower. The other side to this equation is supply, and that's something the Fed has no control over. Global supply chains are still experiencing problems, with China being the primary source. China is committed to a zero COVID policy, irrespective as to how damaging such a policy is on the wider economy. This has naturally led to strains in the global supply chain system as workers are forced to remain at home in lockdown. Shipping costs from Shanghai to the US nearly doubled in 2021, with the IMF estimating that those costs alone could increase inflation by 1.5% in 2022. That's not surprising when you consider that over 200,000 US suppliers are being affected by the zero tolerance policy. Add in the impact of rising energy costs on the back of the Russian invasion of Ukraine, and you can start to see why the stock market is concerned about higher interest rate increases in order to combat all of these inflationary pressures. And that's before we consider the impact that rising rates have on company earnings and the outcome that investors fear the most: a recession. Economists have given a 30% chance for a recession in the United States within the next year, which is double the odds that were predicted just 3 months ago. The key indicator for a recession is GDP growth, or rather a lack thereof. The IMF states that 2 consecutive quarters of decline in a country's gross domestic product, or GDP, is an indication of a recession. While that's not gospel, it is a helpful rule of thumb. The percentage decline in GDP during a recession can be anywhere from 2% all the way to 5% in more severe circumstances. So why exactly is the stock market anticipating a potential recession? The fear is that the interest rate hikes deployed by the Federal Reserve will be overly aggressive, which in turn could cause demand for goods and services to plummet. This would subsequently lead to lower GDP and potentially a recession. Goldman Sachs have cut down their expectations for GDP annual growth in 2023 from 2.2% to 1.6%, while also saying that a recession would push the S&P 500 down to 3,600, which is about 10% lower than its current level. Bear in mind that all of these forecasts are based on best estimates, when the reality is that we simply won't know for certain until we see the data. But the economic data from China isn't helping sentiment, with unemployment rising and output lowering during April. Again, a byproduct of the zero tolerance policies. We know that 4 out of 5 of the last recessions have been preceded by a period of time where the Fed are actively increasing interest rates. So it's not unreasonable for the stock market to have a similar expectation this time around. If that's the case, we can expect lower earnings from companies, which will naturally result in declines in individual stock and broader market valuations. The other factor which is worrying investors is the looming potential of stagflation. Stagflation is a rare economic circumstance whereby inflation and unemployment are high while economic growth is low. Typically, in recessionary conditions, we expect inflation to come down as the demand for goods and services falls. However, the Fed has been criticized for being too slow in combating inflation, with ex-Federal Reserve Chairman Ben Bernanke saying that we're likely facing a future period of stagflation. The idea being that the Fed's interest rate hikes will be enough to slow economic growth and increase unemployment, but won't be enough to curb inflation, especially considering the uncertainty surrounding global supply chains and the conflict in Ukraine. The last time we saw stagflation was in the 1970s, and that came about due to rising energy prices. And while the pressure on commodity prices due to the conflict in Ukraine is subsiding to a certain degree, the long-term impact that this will have on the cost of living remains to be seen. The likes of Ray Dalio shares a similar outlook for the potentiality of a period of stagflation, again for the reasons that we've discussed. So, has the stock market bottomed out? I don't think so. I think there are far too many uncertainties about the future which are preventing investors from having confidence in the idea that the stock market won't drop any further. At the beginning of the month, Morgan Stanley called a bear market rally on the back of any good news, and I think that's how our stock market will continue to exist until we have certainty over A, interest rates, and B, the effects of said interest rates. Any news concerning better than expected inflation data, lower rate hikes, improving supply chains, or an end to conflict will will likely spark short-term price rallies within the market, with riskier assets like growth stocks and cryptocurrencies reaping the best rewards. But ultimately, I can't see a true bottom until we have certainty over our economic circumstances, be that a recession, stagflation, or a successful soft landing by the Fed. To me, what's important to remember is that stocks become less risky, not more, as their prices fall. And so long-term investors have an opportunity to pick up some buys at a discount, irrespective as to whether or not those buys are made right at the bottom. But let me know, what's your investing plan going forward? Are you continuing to dollar cost average into the market, or are you holding cash in anticipation of much lower lows? If you're wondering how I keep up to date with all of the developments in the market and want to use the resources that I use on a daily basis, make sure you check out the first link in the description to get 50% off Seeking Alpha. And if you're from Europe and want to take advantage of the Nasdaq being in a bear market while also grabbing yourself some free shares, check out my partnership links with Book0, DeGiro, or Trading 212 in the description below. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers!